Governing Council today decided to lower the three key ECB interest rates by 25 basis points. In particular, the decision to lower the deposit facility rate through which we steer the monetary policy stance, is based on our updated assessment of the inflation outlook, the dynamic of underlying inflation, and the strength of monetary policy transmission. We are determined to ensure that inflation stabilizes sustainably at our 2% medium-term target. Especially in current conditions of rising uncertainty, we will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission.
Hello, and welcome to Global Business Insights, where we look deeper at the main business stories. Today we look closer at the European Central Bank monetary policy decision and President Christine Lagarde explaining the rationale and also speaking on the new level of uncertainty as risks, she says, are all over the place and how that affects the bank's decisions and guidance. But first, some of the other headlines. President Donald Trump has signed an executive order creating a strategic Bitcoin reserve which will be exclusively funded with Bitcoin seized in criminal and civil forfeiture cases, ensuring that taxpayers bear no financial burden. The order also creates a U.S. digital assets stockpile managed by the Treasury Department to hold other confiscated cryptocurrencies, and of course, again, that will not affect taxpayers. Atlanta Federal Reserve Bank President Raphael Bostic today says policies of the new U.S. administration are putting the U.S. economy into incredible flux, making it unlikely that the Fed will have enough clarity to move on policy before late spring or summer. President Donald Trump yesterday granted temporary tariff exemptions for Canadian and Mexican goods covered by the North American Trade Agreement known as USMCA until April 2nd. April 2 is also when the president is expected to start unveiling plans for so-called reciprocal duties on nations around the world and other sector-specific duties. Canadian companies are already massively front-loading shipments to the United States to avoid incurring higher costs from future levies as negotiations continue. Meanwhile, European automaker stocks also received a boost following sharp declines earlier in the week. The Stocks Autos Index was up 2.5% after US President Trump yesterday announced a one-month tariff exemption that covers automakers. But in the US, the major stock indexes declined sharply, with investors growing weary of the uncertainty fanned by the back-and-forth developments on trade policy. US futures were, however, higher late Thursday as traders sought to look past US trade issues and look ahead to a major payrolls report that is due out later today. U.S. citizens filing new applications for unemployment insurance decreased to 221,000 for the week ending March 1st, also lower than the previous week's unrevised tally of 242,000, also suggesting that the labor market remains stable in February. EU leaders meeting in Brussels agreed to a €150 billion fund for loans to member states and a review of the bloc's spending rules to enable higher defense spending. Norway's government more than doubled, for example, the originally planned aid to Ukraine as it announced €7.2 billion to support the war effort. Listening to European Central Bank, that's ECB boss Madame Christine Lagarde, and attempting to join the dots forming in the geoeconomic and business environment, one thing that seems increasingly common was the rising uncertainty, which also seems to be escalating to levels of late that are making markets much more jittery than usual. Also, obviously magnified by the Trump presidency. Markets yesterday saw Nasdaq closing in correction territory, S&P 500 sinking to record lows, Dow also noticeably down as the latest tariff developments and uncertainty rattled investors. A closer look at uncertainty shows it could reflect different situations and requiring obviously different response depending on the situation that we're talking about. From my observation, there, just for illustration purposes, three broad patterns, and these patterns may to an extent operate simultaneously, but you tend to get a dominant strain. First, uncertainty could be the result of a transition to something very different, birthing a new, less familiar reality, like a mother-to-be in extreme discomfort, but the uncertainty can be a good sign of advent of the new that is coming. For illustration, again, artificial intelligence and the new disruptive digital revolution are leading to new structures, roles, and supply chains are being disrupted as robotics and the prospect of quantum computing is taking us on a journey we have never been before. In the US, they are talking of the cusp of a golden age, at least the Republicans, and we see a different geopolitical dynamic or order, which should not really be a shock. After all, World War II ended 80 years ago, and the value of a unipolar US leadership leading the free world, defending Europe, and championing Western values could be debated. But what replaces the old order? That remains a question, as we see Europe also now waking up to issues related to competitiveness and its own defense. Misreading the transition, whether in the digital revolution or socio-politically, can lead to challenges for the strategist coming up with scenario plans. And of course, not all births end well. The second form of uncertainty could be a temporary blip, like a cold sore, which simply heals itself. Some things will just go away, some will not. Central bankers said inflation was transitory 2 years ago. That was not so. Also, both ECB's Lagarde and Bank of England's Andrew Bailey have presented in their latest inflation update a trend of rising energy costs from higher gas prices. But they say this is only going to be in the near term, and it will on its own fade and not need monetary intervention, which we know requires some transmission time to take effect. There are blips that have to play out, hurt for a while, then dry up and fade. Trump says higher costs from tariffs will be painful for a while and will pass. In Europe and also in the US, many see Trump as the sore that will pass, as many quipped at the last Davos World Economic Forum panel, saying we have seen this before. It is possible that jitters around tariffs will play out and sentiment will normalize and respond more to the fundamentals as time goes on. But misreading a cancerous and spreading growth for a cold sore will not be a minor error of judgment. The final form of uncertainty is the most worrisome. This is the uncertainty that is in reality evidence of final stages of irreversible socioeconomic decline. Almost no one likes to admit that they are facing a decline, even when the data and signs are so compelling. Many politicians are experts in plastering and patching and providing things that don't remedy in any way shocking deteriorations in poverty, expanding inequality, worsening social discontent, and a penchant to just keep borrowing and throwing money at problems requiring a more structural rethink. Also, as output per capita in many of these countries are taking a free fall. Companies do not live forever. History also warns us that civilizations and nations and empires do not as well. Let me summarize. We are in an era of very different and what looks like lingering uncertainty. Listening to how yesterday Madame Lagarde elegantly describes it as they see every new monetary meeting as coming with possible surprises and unforeseen factors. My advice for investors is to diversify your portfolio and consider how to immunize yourself against the inflation, recession, and different scenarios. Business players also need to refamiliarize themselves with their key success factors and closely watch the related data and indices. A quarterly update on data is not going to be enough. You need monthly reviews and even more regular engagement with customers, several informal discussions, motivating your people in particular because they pick things up much faster than the data print. But also saying that the era of uncertainty is also an era of exciting new possibilities in least expected places. In later chats, we will bring guests to talk on how businesses are positioning for uncertainty. But back to our main story. As ECB cuts rates as expected, the tone signaled a more hawkish stance as the ECB statement said that monetary policy is becoming meaningfully less restrictive, which suggests that there is less motivation to ease. Again, listen to Madame Lagarde.
And I think there is a particular sentence in the monetary policy statement which refers to the particularly high uncertainty under which we operate. Because, clearly we have three phenomena that we have debated over the course of this Governing Council. One, the disinflation is on track. That's point number one. Point number two, the monetary policy is becoming meaningfully less restrictive. And point number two, we have huge uncertainty. Some people have used the adjective phenomenal uncertainty, and we debated as to whether it was high and rising, but suffice to say that it is all over. So we have risks all over, uncertainty all over. So under those circumstances, our determination is obviously to reach destination. But we will do so without pre-committing to any particular path. And you have seen that sentence in our monetary policy statement in the past. I think it is even more relevant at the moment, given the level of uncertainty that we have. So we are not pre-committing to a path. And you might have some governors who will say that, I believe that. It is their individual views. I can assure you that the collective view around the table is that we do not pre-commit to a path. And we will be, as ever, and probably more so, data dependent. So if the data indicates to us that in order to reach destination, the appropriate monetary policy should be to cut, we shall do so. But if, on the other hand, the data indicates that it is not the case, then we shall not cut and we will pause. So that's really where we are, not pre-committing, being data dependent as ever, and deciding on a meeting-by-meeting basis.
Asia-Pacific markets mostly fell as yields on long-term Japanese government bonds hit levels not seen since the 2008 financial crisis, and also on heavy selling of technology-related shares. China exports in the January to February period rose 2.3% from a year earlier, significantly undershooting expectations of a 5% rise. Well, that's all we can take on this episode of Global Business Insights. Thanks for watching. This is Bode Oshosami. Bye-bye.